Hey guys, welcome to another Trade Genius podcast. Philip here with Bob, and we got a good one for you because we're going to talk about some metrics we haven't seen since the Great Depression. Pretty significant for our portfolios. You're not going to want to miss this, so stay tuned.
Trade Genius.
Hey guys, this is Bob here. Phil, we've warned them, and we've warned them. And people saying, oh, you guys are just doomers, doomers, doomers. Well, before we get into what we're going to show you today is that we said Friday they were ringing the bell, and we're starting that roll off now. And what we're going to show you next, if it hasn't made you sober, it will, because at some point you run out of oxygen, and we're going to show you how that works. So Phil, why don't you show them a couple of these charts here? This probably will blow people away.
All right, first up, let's take a look at the dumb money confidence. Now, you'll see pretty obvious here on the chart when that gets up to basically the overbought levels. All right, so this is dumb money buying the highs. And when we say dumb money, it's just a slang for people that don't have a lot of experience with trading. A lot of these people got into the call buying frenzy during the post-COVID boom, which was essentially just the Fed pouring money into the system. When the Fed's doing that in a panic type response to what they feel is going to be economic Armageddon, you can buy anywhere and make money. All right. And if you look at the chart above, is the actual chart of the S&P 500, you can see from May 2020 to about where they turned the spigot off toward the end of 2021. See, the market didn't really behave like it did after we got into 2022, where you see a lot more volatility up and down in the market. And that's what we would consider a normal behaving market. You have just natural oversold, overbought levels. Prior to that, you just had this very contrived move, very tight range, but just a steady grind higher because all of that money printing was feeding its way back into the market. So there's a market difference between the beginning of 2022 and post 2022, because now people are going back into the market, buying those highs again, except they're buying the top of the move, and we're getting a series of lower highs and lower lows. So going into Friday, in addition to our indicators, which have a pretty high hit rate on telling us when it's time to exit the move, you also have the laggards, the dumb money coming in trying to buy the move, thinking it's a new bull market when it's not. Now, Bob, this is kind of what we're going to get into now. The other part of this is what we haven't seen since the Great Depression. And I'll just start by saying we have a credit card debt problem here and we have a savings problem. We don't have any savings and our credit card debt's skyrocketing. And that's a huge problem because we're a consumer economy, right? And if we're relying on people buying and keeping our economic engine going and we're maxing out our credit cards, we got a problem because we're approaching stall speed here. And Bob, I was interested in your thoughts of where we are here on the bigger scale of things.
Yeah, look, I mean, just like they do all the time, Phil, they basically take everything to the wall. And, what people did was a lot of people, and we're not telling anybody listening here anything new, is that people got PPP money and companies got EDLI money, and they got deferrals on their tuition payback, and they got deferrals on paying rent, and people got deferrals on credit cards and pushback on paying back SBA loans. You name it, they got deferrals for it. All those things are now wrapping up, and in fact, in February, Phil, is that the food stamp EBT supplemental payment stops as of February 1st. So even with all of that, that the savings rate got pumped, but people spent it.
Right.
They didn't save it.
Right.
And they went to Hawaii. They did this. They bought cars. That's what you see, the cars rolling over now, and they have nothing in the state and nothing in the bank. And so what they did, what they always do, is they got a whole bunch of credit card. What do you call it when you have up to your higher limits on your credit card? And people just jammed them. And now they also raised the rates on credit cards. I think we're at the highest we've ever been on credit card rates.
That's right.
And people are maxed out on them.
Yep.
And so now we have this trifecta coming up on people that you're starting to get unemployment. You have people aren't paying their cars, and people aren't going to be paying their credit cards. And then finally we're going to get the rent again. And so, we're at a point now where you just don't know the exact day of the trigger, but you can see it already. And anecdotally, I see it with people in in business where I live is a lot of business owners, and they're all starting to wave the warning flags. And I live in the bubble area of California where we just don't see people that are struggling, but I'm seeing business owners now that are. And so, once again, we're just trying to give you guys a heads up on it. And the next slide that Phil's going to show you is even worse. And Phil, why don't you take it away with this one? This one is one that really scared me.
Yeah, so it's all coming to a head here. This is like the last chart you want to see after you just digested the first two charts we showed you, which is the real disposable personal income. This is a Fed study. Okay, we have a reading of minus 6.3, and without being overly complicated, you can just simply take this away from this chart, which is when that graph, which is a percentage change from the previous period, when that changes, heads towards zero or dives under zero, you'll notice these gray bars that are around those times. Those are recessions. Okay, this goes back all the way back to the Great Depression. Okay, we haven't seen a reading this low since the Great Depression. It's pretty wild, considering that the stock market's trading up near 4,000 on the S&P 500. So what that's telling you is we are way, way over our skis compared to what's going on under the hood. I think we've said that phrase many times in the last week. Things under the hood are not well. This is another data point. So, again, we have a very positive outlook longer term on everything, but right now you just have to be super careful about being long this market. Be super careful about your portfolios. And like we said, you want to hedge with the ability to go to cash or some other way of maybe hedging your portfolios with short ETFs or put options, or just being short, maybe some micro futures. It really depends on your account size. These are all different things that you guys can do to hedge right now, because if you're up on your 401k or you're up on your portfolios year to date, I think this is a great spot to try to protect those gains, because as this plays out, these are huge macro forces that, this chart is a huge indicator. And the odds of us escaping a recession here with that type of reading on personal disposable income dropping is not very likely. And I think the Fed has silently or quietly told you that, if we do get a recession, it'll be mild. Whenever the Fed tells you, if we get something, it might be mild, run for the hills and expect the worst, because that's how they communicate, because they can't tell you the reality. Otherwise the markets would tank. So they got to slowly boil the frog, in the pot. And that's how they do it. And they've been doing that ever since 2020, in my opinion, on all of these economic data points. So that's why I wanted to do this video today with Bob, is to remind you guys we're nowhere near out of the woods yet.
Yeah, and Phil, if I could just jump in here real quick.
Yeah.
So a negative 6.3% disposable income, that means you're making negative money. I don't know if people can grasp that. And you got to remember, almost 50% of the population receives a transfer payment of some sort, and we're still negative 6.3%. And the chart we're going to show you tomorrow, if that doesn't convince you today, the chart we're going to show you tomorrow is going to tell you that big institutions are hightailing it out of the stock market into the tunes of trillions. So stay tuned for that one. And Phil, thank you for this. This is awesome. Guys, I'm telling you, you'll thank us later. And if anybody wants to trade with us, just go to tradelikeagenius.com. We've got specials running to the end of the month. Get Phil's newsletter, check that out. And if you want to come to Hawaii training with us, check that out too. I'll put my Carnival Barker hat back off, and I'll see you guys tomorrow.
All right. Thanks for watching, guys. Please hit like and subscribe, and also bang that notification button. That really helps us out with YouTube, and we'll keep bringing you these videos. Take care.
Trade Genius.